Hi, everybody. Thanks for joining me. Before we get started, please click subscribe to my channel to keep up with all of my latest personal finance and investing content. And please check out the link you see on your screen for a message from my sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now.
I'm going to get us rolling, and this is an interesting one because they don't pay a very high dividend, but that's MGM Resorts. Dividend yield is currently 0.03%, so not going to make any high yield lists. But when I think about dividends, I think we need to think a lot about what does the future of that dividend look like, not necessarily what are they paying out today. A great example of this is Apple. It's a company that didn't pay a dividend for a really long time, and if you would have bought back in those days, you would have effectively a very high dividend yield today. And what I like about MGM is their business is recovering extremely quickly from the pandemic. I don't know if you knew this, but Las Vegas is reporting record gambling revenue in 2022. That's record all time. You know, the Las Vegas Strip was in sort of a slow decline from, I think it was a peak in 2005 through the beginning of the pandemic. Now people are going there and spending like crazy. In the most recent quarter, Las Vegas Strip actual adjusted EBITDA for MGM Resorts, which is a proxy for cash flow, $846 million. That's a lot of cash flow for a company that has a market cap of around $13 billion. Because remember, that's a quarterly number. And keep in mind that we're getting basically no contribution from Macau right now. Now, one upside for MGM Resorts is if the customers that visit Macau act the same way that customers that visit Las Vegas and just kind of go crazy when the Chinese economy opens up, that means that there could be a flood of cash flow coming from Macau on top of the already really great numbers out of Las Vegas. That's why I think this is a great cash flow business. The dividend yield isn't high today, but frankly, there's nowhere for them to spend this money. They can pay down debt. They can do that for a few years, but you probably still want to have a little bit of leverage on the balance sheet. They've already sold off most of their real estate. So what are you going to do with the cash? You can't expand much in gambling anywhere around the world right now. So dividends is the next step, and I think that's where we're going. What do you think about that one, Matt?
I like that one, and not just because I'm a customer. I enjoy. I think they have the best product in Las Vegas, at least. Their hotels are the best. They have the best restaurants compared to some of their rivals. So I like that, and I do agree that their dividend is going to rise going forward because, like you said, there's limited ways to reinvest the profits going forward.
What is your first pick for our top dividend stocks?
In no particular order. My first one is a company called Ally Financial. Ticker is ALLY. If that's not familiar to you, they were formerly General Motors' financing arm before the financial crisis, and the whole bankruptcy restructuring ended up getting spun out. So it shouldn't come as a major surprise that its number one business is auto lending. Ally has a huge high-yield deposit platform, which is great, and it gives it an advantage over a lot of the other big fintech operators because it finances all of its auto loans and then some with low-cost deposits. It's set up for massive profitability. Its average auto loan has an interest rate in the 7 to 8% range, and it pays an average of less than 2% on its deposits. That's a pretty healthy spread compared to lenders that have to finance their loans by taking on debt, where maybe they're getting 7 to 8% yields and paying 4 or 5% on their debt. So really profitable business model. The big fear right now is that auto lending is at an inflection point, if you will. People have been paying over MSRP for cars for a year and a half now. A lot of people are very underwater on their car loan. And there's a big fear that if a recession hits and unemployment ticks up, that a lot of people are going to run into trouble paying on their car loans. That's a legitimate fear, but one that I think is baked into the stock price at this point and then some. It's well over 50% down from its high. It pays a 4.6% dividend yield that is well covered by its earnings. It represents about a 20% payout ratio right now. The stock trades for, and get this, I'm not misspeaking, 4.4 times earnings, 4.4 PE ratio.
So what the market is telling you there is that they don't believe that those earnings are sustainable. And I think you kind of made the case that they might not be, but the question is how far will they fall? And what you're arguing is that there's enough cushion there that there's still going to be a really nice dividend.
Yeah, let's say that I'm wrong and profits get cut in half.
Yeah,
you're still covering your dividend more than twice over, and your PE is still under 9. So I mean, I think the risk reward here makes a lot of sense, and a lot would have to go wrong before this business just became unprofitable. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.